Hello, my name is Derek Afasi and welcome to your first video in this training series. Now, the main purpose of all these videos is for you to eventually create some sort of safe, sustainable, secure, maximized retirement income. Now, the video I want to go over just does a very broad generalization on different things for retirement, your different retirement vehicles, and the three money worlds that we all live in. Whether we start off when we're first working and we start to accumulate, to when we start to preserve and make sure that that income is maximized. In the introductory video, we stated that we want to make sure that you have some sort of sequential income planning system in place. You understand that now is the time, whether in your 40s, 50s, 60s, or currently in your retirement, you need to create some sort of retirement income. You don't want to try to invest your money in the market because you have to understand that the market is volatile, and you want to make sure that you're at least sustaining and preserving your accounts of your previous growth, and you want to make sure that you have certain laddering strategies set up and sequential income planning systems set up to properly allocate towards each segment of your financial goals. So the three money worlds, these are the three money worlds that we all live in. The first world is the world of the protection. This is the world of the guaranteed. This is the world of the known. Now, the world of the protection is a world that you will gain very small interest because, as stated in previous videos, and to always be mindful of is the more risk that you take on, the higher the potential rate of return. The less risk that you take on, the potential rate of return is going to be much smaller. So the three animals that live in this world are, you have banks, you have the government lives in this world, and you have insurance companies. So this is the world of the protection. This is your safe world. The banks offer something called CDs, or certificates of deposit. You go to a bank, you give them X amount of money, and they state, as long as we hold it for X amount of time, we'll give you a percentage of interest. The longer that we can hold it, the higher your interest will be. Hence, the less, basically, the more liquid your accounts are, the less that they could actually give you a higher rate of return. So this is CDs, savings accounts, money market accounts, they all live in that world for the banks. The government offers you something called treasury bonds, T-bills. And once again, you're giving them money, and the longer the duration, the higher your interest rate will be. But ultimately, this is for this is for your safety. And insurance companies offer something called fixed annuities, which correlate and kind of emulate how a bank works with their certificates of deposit. You give them X amount of dollars, and they give you a smaller interest rate. Typically, it's about 2 to 3 times higher than a typical bank CD, but understanding that you're going to receive some sort of interest. And this is mainly for your preservation. This is mainly just to say, you know what, I want a return of my money, not necessarily a return on my money. So what are the advantages of this? Well, the advantages is that everything's guaranteed. The way that they guarantee these accounts is you have something called the legal reserve system. The banks have something called FDIC. Meaning that if a bank was to go under, they could borrow against the Fed to pay back that money to their investors, to their clients of the bank. So hence your bank CDs, and they do it up to a certain limit. It could be $250,000 to non-interest-bearing accounts, and that could fluctuate every year. The government, you understand that the money that you're giving them, it's safe money because the government's not going to go under. So you could always say, okay, well, as long as I'm investing into the government, they're at least going to be able to either print more money, whatever the case may be, but they're going to be able to at least pay me back whatever I gave them plus interest. And you have insurance companies which offer something called fixed annuities. And insurance companies in this world, because they have to have, by law, they have to have tiers of safety, state guarantee funds, they have to have certain things that, in order to be accepted by the state to offer their products, they have to go through rigorous tasks to understand that we have to be as safe as possible. And just a little quick fact, the insurance companies, during the Great Depression, insurance companies are the most stable. They have to have dollar for dollar reserves. Every dollar they loan out, they have to have in reserves. Now a bank has to, for every dollar they loan out, for every $10 they loan out, they only have to have $1 in reserves. So the bank makes money by loaning your money out constantly. The insurance companies, they have a process of general accounts, and they also make sure that they're backed by reinsurers, either all throughout the state or different parameters. So this is fixed annuities as well. The advantages of all three of these entities is that we have the guarantees. Your principal, whatever you gave, is guaranteed. Your earnings are guaranteed. And typically your term is also guaranteed. That sounds excellent. You say, wow, I'll just throw all my money in there. That's perfect. That's perfect. There's something called inflation risk, which does not help right now because current bank CDs are roughly about 1%. It's horrible. Current fixed annuity rates are about roughly between 2 to 4%, 2 to 3%. And the government treasury bills, T-bonds, are going to be right around the same exact thing. So you have guarantees, the principal, earnings, and term. The disadvantages is you have extremely low earnings. You're not risking because you understand that you're going into more of a guaranteed basis. And also, if you have certain segments and you're locking up your money, there could be penalties for early withdrawals. So you say, okay, I understand that. Now you need to have some money in the protection. You need to have it. You need to have it in banks. You need to make sure it's there. You need to have that sort of safety factor. But you also have to always link up and be mindful, what exactly are my goals? What is my goal to make sure that all my assets go towards some sort of retirement income for me? Is it to just make sure that's preserved for to leave money to beneficiaries? What exactly are your goals? So the rates of return, the potential return on these accounts typically range from currently about 1 to 3%. Now, rule of thumb is they say that inflation increases by 3% every year. Those are the cost of goods. Will be increasing, hence a gallon of gas is a lot different 20 years ago than it is today. A gallon of milk, everything will be increasing with consumer goods. So you understand that, okay, this is a great world, but if I'm only really getting 1 to 3% and inflation is increasing by 3% every year, it's good to have some money here, but I also have to have some sorts of rates of return. I need to start taking some risk. So you understand that when you started working, you're like, okay, I'm not going to retire yet. I'm in my 20s, I'm in my 30s, I'm not going to retire yet. I'm going to retire when I'm in my 60s. So you said, rather than just locking your money up in a savings account, getting this very small interest or throwing it under a mattress, you have to invest it somehow into the market. And that brings us to the world of the potential. The world of the potential is basically the complete opposite of the world of the protection. The world of the potential is the world of the not guaranteed, is the world of the unknown. And you do have three monsters that live in that world as well. First, you have mutual funds, mutual fund companies, then you have brokerage houses, and then you have insurance companies. What's offered through mutual fund companies? Well, mutual funds. And a mutual fund, all a mutual fund it is a mixture of stocks and bonds. So if you see in your employer benefits, you might see something that says, okay, I have an aggressive allocation. This means that they're investing in some sort of mutual fund, whether that be through American Funds, Fidelity, T. Rowe Price. Aggressive is typically at 80% stocks, 20% bonds. A moderate, typically 60% stocks, 40% bonds. Conservative could be 70% bond, 30% stocks, depending upon what it is, and then you might have a fixed account, a general account. You might use international funds. It's just a way to understand that where you're investing, they're pooling the law of large numbers to make sure that you have a share and millions of other people have a share so that you're not buying individual stocks or individual bonds. Mutual funds. The next thing is brokerage houses, which offer mutual funds as well. They offer stocks, bonds, limited partnerships, real estate investment trusts. They offer options, commodities. They offer basically anything that you could think of that will give you some sort of return. But once again, we have to realize that these are not guaranteed. This is the world of the known. This is the world of the potential, world of the not guaranteed. So in a given year, you could earn 40%, but you could also lose 40%. Hence, when everybody lost their money in 2008 in the market, when everything crashed, they were too heavily invested in the world of the potential and not the world of the protection, or at least mixing out throughout amongst those three. You also have the insurance companies offer something called a variable annuity, which with SafeNurseRetirement.com, none of our advisors offer the variable annuities unless you are basically below right around the age of 40 or below. They're extremely risky. They basically have very high fees, and we could explain that into a different conversation, but just understand that your money is invested into the market. It's all invested into the market. So what would be some of the criteria with the world of the potential? As I reiterated, you could gain 40% in a given year, which is excellent. You could lose 40% in a given year. So essentially what you have is you don't have any guarantees. Your principal, meaning the amount of money you placed in there, is not guaranteed. Your earnings, they're not guaranteed. And your term, that's not guaranteed either. So, principal, earnings, term. The good thing is that it is liquid though. I mean, you can basically, it is liquid cash, meaning you have easy access to it. So the advantages is that it's liquid and that you have earnings potential. You have the potential to earn great numbers. Now the disadvantages is the fact that you don't have any guarantees. So your rate of return, your potential rate of return can be negative 40%, or it could be positive 40%. Now, there's something that I always reiterate back to is from 1980 to 2000, we had the largest growth in the market. We had a 1,000% growth in the market. So what happened was a lot of these baby boomers, a lot of these people getting ready for retirement, they had something called defined contribution plans, meaning that rather than a pension plan, which is a defined benefit, they're defining what your benefit will be. You're giving them X amount of money, and they say, okay, as long as you're working here, X amount of years of service will define your benefit. In 1974, ERISA came out with something, Employer Retirement Income Securities Act, which changed the plans from defined benefit plans because it was too risky for the employer and threw the risk on the employee. So you had all these people, all these baby boomers that were now throwing money into the market. They were now putting all this money into the market. Hence, why we've seen large market growth from 1980 to 2000. And then also you had the tech bubble, different types of bubbles that helped out as well. Now there's a theory out there, it's a technique called the prudent man's rule. Just erase this. And what this says is you should be taking roughly about 4% of your money if you had it within the world of the potential. It should be about a safe haven. And you could look at this on T. Rowe Price, you could look at this on Fidelity, whatever it is. And what they're saying is as long as the markets are going up, a safe withdrawal rate should be about 4%. And there's about a 90% chance that you're not going to outlive your money, which could get scary. It could definitely get scary because in 2011, T. Rowe Price did a study from retirees that retired in 2000, And because from 2000 to currently 2012, we've been seeing a bearish market. So 2011, they released a study stating that at 4% withdrawal rate, if they were in a moderate portfolio, basically comprised of 60% stocks, 40% bonds, that right now, what we used to think was a 90% chance of success, which I still don't like. I only like 100% chance. I always tailor it back to if I'm on an airplane, and I state, if the pilot comes on the loudspeaker and he says, "Oh, excellent news, guys! We have clear skies, and there's a 90% chance that our flight is going to arrive safely." Everyone would be freaking out, including myself, and would be getting off the plane. That's the same way you have to treat retirement. You only have to go with things. You have to go with things that are 100% guaranteed. You cannot guess. You cannot trust an advisor or a family friend. Say, "Oh no, don't worry about it. The market's going to do great. It's going to do great. It's going to bounce back." Nobody knows. It is an unguaranteed. It's a potential. It's an unknown world. So, in 2011, when they reviewed these same accounts, they said, "Oh no, 4%. If you're at least in a moderate portfolio, would be a good deal." The chance of success went from 90% down to 6%. Because what happened was, you cannot take money from an account that could potentially go down. And a quick example is, if you're taking money from an account, let's say your account lost 10% in a given year, and you're taking 4% distributions, and the people that are monitoring your account, your financial advisor or whatever, the fund managers that are in there, let's say they're taking another 2% from sub-accounts or whatever their monitoring services are, you can lose 16% in a given year. Now the next year, if you gain 5%, say, "Okay, well, I gained some money." No. First, if you gain 5% off of a smaller number, and then you have to incorporate, you're taking 4% of that, and you're getting hit with another fee of 2%, so you actually lost 1% that year on your accounts. And you keep doing it. So the larger the loss, or even if you have a small loss or even a small gain, it's going to hinder your accounts. So that's why you've seen this chance of success go from 90% all the way down to now there's only about a 6% chance, and people do not like that. They do not like that at all. So it brings us to the world of the hybrid. We state the world of the protection, it's good because my money's protected, but the rate of return is so low. And inflation could beat that. So I want to at least go into some world of potential. And understand, when you're investing in the world of the potential, a way that a stock works, whenever I'm talking about the mixture of stocks and bonds, a stock, you're investing in a company and you're hoping that the company is going to be profitable. A bond, you're investing that the company is just not going to go under. So a bond, you're giving X amount of money and they're going to pay you X amount of interest. So the worst, if you ever heard a term called junk bonds, meaning that the company is not stable, so they'll offer you a higher rate of interest, but you're taking that risk that the company could potentially go under. So you just want to make sure the companies are staying afloat. So that's why they state that bonds are safer than stocks, because stocks, you're just hoping that the company's going to be going up, while bonds, you're just hoping that the company's not going to go out of business. Kind of like a student loan company was to invest into your education, and they state, okay, we'll give you this $20,000, but you're going to have to pay us 5% interest throughout your lifetime for X amount of years, and they're betting that you're going to be paying it back. You're going to be paying back their $20,000 plus whatever the interest is. That's exactly what you're doing with the bond. So a mutual fund is a mixture of those stocks and bonds. So a lot of people state, I understand the world of the protection, I understand the world of the potential, and you have to have money in potential. In the protection, you have to have money in the potential. Now, the main thing that we like to talk about is sequential income planning systems. You have to have an income planning system, and you have to understand what are your minimum, your daily expenses, what are your accounts. You have to grab all your accounts and understand what is the exact amount, and then do the math with what exactly do I need? What is the most important thing that I need for my retirement? And when you determine what that is, and that's exactly what we help you out with, that's what a sequential income planning system is. You understand at age 60, I need this much, but inflation is going to be increasing. So age 65, age 70, age 75, and you have to make sure that there's certain laddering strategies set up so that new income is coming to you. The world of the hybrid, they have a little bit of the protection and a little bit of the potential. They state that we're going to treat your accounts like a fixed account. So we're going to have the legal reserve system backing, but we're not going to give small interest. We're going to gain interest on this account, the small interest that you would on a fixed account, but rather than giving it back into your accounts because it's small, we're going to invest the interest into the market. So we're going to risk the interest, we're not going to risk the principal. So essentially, you have a guaranteed principal, your earnings are not guaranteed, but you have earnings potential. So if the market is going down every single year, you understand that if the market's going down, my principal is at least secure. If the market's going up, you're going to participate in the upward markets. You're not going to gain all the market growth as if you did in the world of the potential because you're not investing your whole lump sum in there. We're taking a little bit of risk with a little bit of return. But understanding that you have the guaranteed principal, you don't have the guaranteed earnings, but you have the earnings potential. And there's two animals that live in this world. You have the banks and you have the insurance companies. The banks offer something called enhanced credit-linked CDs, which are extremely rare to come by. And the insurance companies recently came out in the last few years, they came out with something called a fixed indexed annuity with income rider. And that is very, very big to understand. An income rider. It's not going to be an income rider like a variable annuity, which are tacked on with high fees, because ultimately your actual account, the money is still invested into the market. This, we're investing it into the index where we're only risking your principal, we're only risking your interest, we're not risking your principal. And these products, the hybrid products, fixed index annuity with income rider, it's an income annuity. It acts as a personal pension plan. So depending upon what your funds are, if you have 401ks, 403bs, you have to segment them out. Is this qualified money? Is this non-qualified money? Meaning, is this qualified money? Am I going to have to pay full taxes on that on my tax bracket when I start income distributions? Is it non-qualified money? Do I have a little bit more tax favorability? Something called an exclusion ratio. So the main purpose of these accounts is to maximize income. On the accounts that we work with, and what we've done is we have set up relationships with the top companies out there. And we understand, we told them, listen, we're dealing specifically with nurses. These are the type of people the nurses are. These are the type of jobs. They're always constantly changing from employer to employer. So we're able to offer you the highest rates of return on your accounts. That's specifically why this whole program was set up for the nurses. It's for you guys to take advantage of our company and to take advantage of the different interest rates, the high guaranteed interest rates out there. So the advantages of this product is, number one is we have safety. Safety. Your income accounts go by a legal reserve system, kind of just like a fixed annuity, but it's a fixed index annuity. So you're going to have the safety. You're going to have those tiers of backing. And if you're in a state that they don't offer it, then it did not get accepted by that state. They understand that there might be certain restrictions. New York is one of those states that do not offer them. I believe all the other 49 states, depending upon which state you live in, we could obviously check and we could see which one would be the best route for you. You have growth potential. Because you're not risking the principal, you're risking the interest, you have certain types of growth potential in there. And the main purpose of this is to guarantee income. As your account is either going up with the market, participating in market gains, or flatlining in market losses, you have a separate account just based for income. Now, these income accounts, depending upon your age, we're currently offering 6 to 8% guarantees on your actual income accounts, the money that you're going to take on income purposes. When you touch this money, these are guaranteed insurance contracts that you could never outlive your money. They state in the contract, they state when you turn on your income distributions, you're not going to lose the preservation side on your actual account. You're not surrendering over your contract and committing something called annuitization. What we're doing is we're keeping it within the terms of the contract. You're going to have an account value that is ultimately going to be preserved, and your income account that is going to be where you take the income from. Now, if your account value goes higher than whatever the guarantee is, then your income account will obviously step up. But what happens is at that point in time, say you're 60, 65, whenever you want to retire, what this rate of return, the 4% potential, what we're saying, okay, maybe that this is going to be a safe withdrawal rate with the 90%, we offer in between, depending upon your age, 5 to 7% income from a much larger account that you cannot outlive. Let's say you're taking 5% from an account at $100,000. If you live past 20 years, any other product, that money would stop. It would completely stop. With our product, they're contractually obligated to keep paying you. Now, let's say you die in year 5. You've only spent $25,000. They're going to credit you. They're going to credit your beneficiaries what your account value is. Now, remember, your account value is still gaining within the market during this time. Your account value plus whatever basically whatever you did not take, and that's going to go to your beneficiaries. You're not losing out. You're not committing annuicide and annuitizing so that the insurance companies could have their way. So you have these guaranteed income comes to you through income riders. And they're extremely cheap. Whenever you compare apples to apples with a variable annuity versus a hybrid annuity, it is astronomical. A variable annuity, I've seen one as high as 6% every year in fees. These ones, they typically range from 0.25% on your actual account to 0.95%. So it's typically the ones that we deal with is less than 1%. So what is your actual rate of return over here? Your potential rate of return. It could be 0%, or it could go as high as 15%, whatever it is. So once again, these are the 3 money worlds, and this is the first video of our series of videos to make sure that you could have a safe, sustainable, maximized retirement income regardless of what the markets do. You want to be in the world of the protection. You want to have some money there because you're going to need it for some safety, for some liquidity. You want to make sure that that's preserved over there. You're going to have some money in the potential. If we determine that you need X amount of money, you have to have a sequential income planning system. You have to have a laddering strategy set up. And that's exactly what we do at SafeNurseRetirement.com is we help you on your specific situation. What are your goals? How exactly do you get there? And how exactly could you leverage the certain companies to make sure that you're going to have maximized income and you're going to be able to preserve your accounts as best as possible. So you can leave those accounts as either inheritance or you can have it as fund money. If you need family members to fly down here, that's your additional money. That could be your riskier money in the potential. If you want to have some fun, that's your gambling money. Your protection is going to be more some of your safe money. In the world of the hybrid is still going to give you your safety, but this is used for income maximization. So it's not good if you don't have income purposes, or if you have income, if you have certain income goals up to a certain amount, you want to have a large portion of it to just cover the income. That's your guaranteed income. This is your potential. Still allow you to earn potential on your earnings, on your accounts, and you also have the world of the protection. So this is the first step of the sequential income planning system. Please view our next video tomorrow that we're going to be discussing the 4% withdrawal rate. And we kind of touched base on that a little bit. We're going to go into more detail of exactly why the 4% withdrawal rate has not worked in the past and what is some of the cons to it. Please visit us. You could give us a call at our 800 number. And thank you very much. Once again, my name is Derek Afasi.